Well, we are going to keep focused on this top story of the day. Federal Reserve Chairman Ben Bernanke going to be nominated to a second term by President Barack Obama today. Bernanke, as you know, led the biggest expansion of the central bank's power in its 95-year history to battle the worst economic slump since the Great Depression. So what does this announcement mean for the bond market? We bring in Michael Pond. He is interest rate strategist at Barclays Capital for his take. Michael, always glad to have you with us. So this is not really a surprise, right, that President Obama is nominating Bernanke for the second term. Is the timing a surprise?
Well, it certainly would have been a surprise had the announcement gone the other way, if Obama had nominated someone else. But what this does is take some uncertainty out of the market, just takes that question off the table, which is important to reduce some of the volatility that we've been seeing in the bond market. From a longer-term perspective, though, the Fed still needs to convince the market that it can and will implement its exit strategy from all the stimulus that it's been putting into the market at the same time that it keeps that stimulus in place for an extended period of time.
The Fed is really between a rock and a hard place in this situation. I mean, one worry, just to kind of key off what you're saying there, is, of course, this long-term prospect of inflation. Do you see these worries creeping in? I mean, is that part of the reason we've seen volatility?
That's part of it for sure. And what we've seen is forward-looking inflation measures, such as the five-year inflation rate has been creeping up back to the upper end of its historical range. That's in part because inflation uncertainty has begun to creep up because of what the Fed is doing.
Michael, I want to ask you a question that's related to Ben Bernanke. It has to do with a piece of news that broke late yesterday. The Fed being ordered by a judge to release the details of its lending program, some of the swaps where banks put up some toxic collateral, got treasuries in return. How might this affect treasuries? Because, as you know, transparency among the few complaints that people have had about Ben Bernanke and the Fed.
That's right. Well, you know, to some extent, keeping that information within the Fed might be important in that banks may be less willing to go to the Fed and ask for cash when they need it if they think that could create a negative situation in the market for them.
And drain some liquidity out of the Treasury market as a consequence.
That's right. So, you know, this is probably not a positive for banks, but, this is information that is now 6 to 9 months old, so hopefully it'll be seen as old news.
Over the next 3 days, you mentioned the 5-year. There is this record-selling week, or I should say matching record-selling week, of $109 billion, 2 5-7-year notes. What do you expect?
Well, it seems like every 2 weeks we get a record auction, a record amount of issuance within treasuries. And what's important is that's going to be the case for many years to come. The government's set to announce that the debt to GDP ratio is expected to rise to around 82% over the next 10 years. Demand still is in place right now, and so we expect the auctions to go relatively well. The 2-year may struggle a bit, as it's just over 1%, and last month at 1.08%, that was a pretty poor auction, and we're now lower in yield, so it's not clear that demand will be there. But over time, that demand will begin to wane as the economy improves, and that's when it will be more difficult for the Treasury to issue.
Michael, 15 to 20 seconds left. Who's buying this stuff? Is it Americans saving more? Is it the foreign buyers who are still buying despite their rhetoric?
It's a broad base of investors coming into the Treasury market. So foreigners do continue to buy at an increasing pace, but importantly, they're not keeping up with the increase in supply, which means that domestic investors have to step up. Part of that has been because of individual investors and the increase in the savings rate.
All right, Michael, thank you so much, as always, for stopping by. Michael Pond, interest rate strategist at Barclays Capital.